In this video, we will introduce consumer credit, just the basics. So financing alternatives, meaning different ways that you can access money now outside of your current savings and the trade-offs of doing so. So 3 ways you can buy something. You can use your money in your savings account. You can use your paycheck when it comes in, or you can borrow against expected future income. That means credit cards, loan, etc. So you take money now and use future income to pay it, but it's going to come at a cost. We know it is interest rate. Trade-offs. Depleting savings reduces emergency funds. So you start dipping in your savings, you may come across financial stress in the future in case of an emergency. And emergencies will happen eventually. Spending current income on luxuries will eventually reduce your future well-being. This is a way to say that if you spend money now, you're not saving and investing, and in the future, you may not have money to retire or to live a better life above your standard income, because you'll have additional income from investments. Spending future income now reduces funds available for future expenses. So if you borrow money or use your credit card, you have to use money that comes in later to pay it back at a higher cost because of the interest rate. So that's going to hit your savings account, your investments, and your quality of life in the future. Uses and misuses of credit. You can ask yourself several questions to see if it's a good idea to use a credit card or loan to buy at the time. Do you have the cash for the down payment? This will apply for cars and houses. Do I want to use my savings for this purchase? Maybe if you planned it some time ago and you were saving for that purchase, then sure, but that should be above and beyond the emergency fund or any other retirement account investments you had. Does the purchase fit my budget? Well, self-explanatory. Are you living within your means? Are you living within your income level? Could I use the credit I need in some better way? There's an opportunity cost issue here. I can use my credit to buy this, or I can use my credit to buy that. There might be better choices on how you should deploy the use of that money. Can I postpone this purchase? It's better if you postpone it, because then you can save up for it. Also, while saving it, it could earn interest. So it actually reduces your actual cost of purchasing it. What are the opportunity costs of postponing this purchase? Okay. So obviously, if you don't buy it now, there are some things you're giving up. If it's a leisure item or want item, you're giving up the pleasure of owning it now. But if it's a house that you're going to buy, there is some opportunity cost of rent versus buy. Sometimes it's better to rent a little longer and buy later. Sometimes it's not. It depends. What are the dollar and psychological cost of using credit for this purchase? When they talk about the dollar amount, they're talking about strictly what we mentioned, that you're going to have to pay interest on it later. Psychological costs, not the benefits, because if it's a leisure item, the psychological benefit is you feel better because you have it now. You get to enjoy it now. Psychological cost is that having this debt hovering over you may make you feel bad. Let's just put it that way. A lot of people get stressed as they see their debt. At the moment of the purchase, they're not thinking of the future stress debt may cause them, and not just financial stress, psychological stress. Importance and advantage of credit. So we're not saying do not use credit cards or do not use credit at all, because there are some benefits to having access to credit. Consumer credit, it's a major force in the American economy. That's for a different discussion, the macroeconomy and the business and the finance sector, how businesses benefit from this. But let's talk about you as an individual. You have immediate access to goods and services. Well, as we mentioned, you get it now. You don't have to wait. Permits purchase even when funds are low. So a house is always a good example that it's not necessarily a bad thing, but if you were to wait until you can save up to pay for the house cash, that might be a really difficult task. Plus, you might be giving up a lot of money in rent by the time that comes around. So you're able to then buy a house early without having to spend hundreds of thousands of dollars. A cushion for financial emergencies. You may have an emergency fund in place, but either you may have one large emergency, then now you need to use some credit to cover it, or you may have a series of emergencies that happened close to each other. So they were depleting your emergency fund and you were not able to build it back up. So now you have to tap into credit. Advance notice of sales. They're talking about you might get some perks and benefits. That's just one of them of using credit. You may get discounts, etc. Easier to return merchandise, convenient when shopping. The easier to return merchandise, we're talking about the ease of also getting a refund. And there's we're going to talk about it here in the next slide, where credit cards, when you use a credit card to buy something, they don't immediately give the cash to the seller. It could take 30 days. So those 30 days, it's kind of a grace period that works to your advantage, not just because you might get a interest rate grace period, but it's easier to deal with returns with companies because they know they don't have the cash yet. And if they don't want to take a return, you can always have the credit card stop payment for different reasons. It doesn't automatically happen. You have to have a good reason, but it's an advantage of having that power. Convenient when shopping, you're not carrying cash. The card is right there, easy. Importance and advantage of credits, one monthly payment. So you can go ahead and do all the shopping you got to do throughout the month and then just pay all of them back at the end of the month. And you didn't have to carry cash or constantly dealing with the transactions, especially since you may have a grace period where no interest is accumulated. You pay it within 25, 30 days. Safer than cash for obvious reasons. Needed for hotel reservations, car rentals, and shopping by phone. Internet, I don't know why they don't have that there, but it's the same concept. A lot of things that are very convenient or that you may need, they will require to have some kind of credit card in order to secure the sale. Can take advantage of float time and grace periods. That's the amount of time I was talking about that you don't pay interest. And if you pay it back before then, it didn't cost you anything to use the credit card. May get rebates, extended manufacturer's warranties, or emergency medical evacuation for travelers and other bonuses. That's a very common practice now. Every credit card out there advertises the different benefits they can offer you. So yeah, you do get some value out of that. It could be an indication of financial stability. Having a credit card builds your credit, and it may show you the fact that you are able to have credit, that you have financial stability to other creditors. But also, when we talked about how it could help you for emergency situations, that also helps for financial stability without having to dip in some other sources of money that could be even worse than using a credit card. Disadvantages: temptation to overspend is the most common problem. People see that they have the credit available, said, okay, I can buy this, I can buy that. Next thing you know, you have huge amounts of credit card debt. Failure to repay loan may result in loss of income, valuable property, and your good reputation. Loss of income, valuable property, yes, debt collectors can come after your money, your paycheck, they come after your house, your car, etc. And good reputation, not only just reputation in general, but it will reflect on your credit report. Remember that credit reports are not only used for future credit applications, but job applications also are looking at credit reports. Your insurance company may look at your credit report. Misuse of credit can create serious long-term financial problems, damage family relationships, and a slowing of progress toward financial goals. All these are self-explanatory, but let's talk about family relationships. They can come in a variety of ways. The easy one to use as an example is in a marriage, your spouse. If one spouse is irresponsible with the finances and create financial problems, it can really damage the family in that sense. But it also happens between siblings, parents and sons, etc. Sons and daughters. It does not increase total purchasing power. It may feel like you can buy more because you have it. No. What you're doing is you're increasing your purchasing power now, but decreasing it in the future. That's all it's doing. It's just taking, but the amount it increases now is less than the amount it decreases from the future. So you end up paying more for it is another way to see that. Credit costs money, interest rate. Some other types of credit, there are a lot of different ways, but we got the close-end credit. That's your typical loan, like your mortgage or car loan. And it's shows right here, mortgage, automobile, installment loan. So it's a fixed amount for a period of time. And as you pay it down, it doesn't necessarily mean that you can continue to use that money you paid down. There are ways to access equity, but it's not through the same loan. Open end, think of them as your credit cards that as you pay it down, you can then use the money again, etc. Here's a list of a few common ones, but it's not all of them. Close-end credit, like mortgage, automobile, cars, installment loans, like signature loans, etc. Now, open-end credits, that's your credit cards. That's the most common one. Use as needed until reaching line of credit is maximum. So it goes up and down the line of credit, the open-end ones. And then as you bring it down, you can just go ahead and reuse that available amount. Debit credit card fraud. Protecting yourself against debit credit card fraud. Happens all the time. You hear it in the news all the time. Very common since the internet. Things that you can do to avoid, or not avoid, but reduce the risk of credit card fraud. At any given, you can never really stop it. You can just reduce the risk and become a harder target, so they go after other people. Sign new cards as soon as they arrive. Treat cards like money. Keep them in a secure place. Shred anything with your account number on it. Don't give your card number over the phone or online unless you initiate the call. And don't write it on postcards. Get card and receipts after, get card and receipt after every transaction and check for billing statement errors. Notify the card issuer if you don't get your billing statement or if your card is lost or stolen. This here, get a card receipt after every transaction. One thing that happens a lot, and you could reduce the risk. An example of what I'm talking about is at a restaurant. You give the card to the waiter or waitress. They take it away for some time and then come back after they ran it. The thing is that, and it happens, they may take a picture of the card or copy the information as they take it away from you during that period of time. When we can reduce it is just to ask for you to go straight to the register and you pay directly and observe the person. It may seem awkward, but unless you don't want to take that risk, then that's how you have to do it. Or don't eat in restaurants that do that. Making purchases online. Common sense, use a secure browser. If you don't know how to see if you're in a secure browser, you can look up online, and part of the tricks is you can look at where the URL address is. There's some either symbols or some letters that will let you know if it's in a secured, if it's doing a secure process. Keep records of online transactions, and the reason is so if you do get hit, at least you can see where it might have happened. Review monthly bank and credit card statements. A lot of people are guilty of not reviewing this. All of a sudden, there's a $3 charge, a $30 charge, or a $1,000 charge in there, and you don't know where it came from. Read policies of the websites you visit concerning refunds, site security, and privacy. Well, a lot of people don't do that. And I'm probably one of them that doesn't read a lot of the policies. I do check the secure browser thing, but if you were to read every policy in every website, yes, it increases your safety and security. You want to do business with them, but the time consumption to do that with so many websites, it's up to you for the trade-off. Keep personal information private unless you know who is gathering it and why. Give payment information only to businesses you know and trust. And that ties in with the previous comment we made about when initiating the phone call. If they're calling you, you definitely don't want to share information over the phone. Never give your password to anyone online. Do not download files sent to you by strangers. Measuring your credit capacity. Can you afford a loan? This goes back or related in a way in the previous slide where you were asking yourself a series of questions if you should make that purchase on credit. Kind of similar idea. Ask yourself, you can meet all essential expenses and still afford the monthly loan payments. This, I guess, one time that happens a lot, people when they're shopping for a home, they keep on saying, well, I can buy a bigger house, a little more money, and all that is only so much, a few dollars extra a month, but then they keep on stretching that monthly payment and they find themselves in a situation where their other typical expenses suffer because when they took the loan, they were not thinking about how much it was going to impact that cash and other expenses. Ask yourself, what do you plan to give up in order to make the monthly payment? So if you wanted that bigger home, nothing wrong with that. But do understand that if you continue to put pressure through a higher mortgage payment, you're going to have to give up something on the other side, on something else. Maybe eat out less, downgrade your car, buy clothing less often, less traveling, less movies, so on. Let's talk a little bit about some numbers that can be calculated. Debt payments to income ratio. At the end of the day, you take your monthly debt payments, any payment that you do to credit cards, loans, etc., that are debt. You want to go ahead and divide it by your net monthly income. That is your income after taxes. If that number comes out to above 20%, you might want to reconsider and review your financial habits. Obviously, the lower this is, the better, because then more money can go into savings and investments. Then we have the debt to equity. We spoke in our previous chapter how to calculate your net worth. Assets minus total liabilities equals net worth. So then you take that total liabilities and then you divide it by the net worth. You want to have more net worth than liabilities. That's why it says it should be less than 1. However, as a college student, you might be what we call a deficit spender. There may be periods of times where this is greater than 1, but that should be temporary. There should be already a plan in place why it's happening. And then as soon as possible, turn it around to becomes less than 1. So your liabilities are less than your net worth. You want to have more net worth than liabilities. Let's talk about co-signing a loan. We have 2 slides dedicated to talking about co-signing a loan. But the most important thing you need to understand here is this is a high risk maneuver. And unless you're married to the person, co-signing a loan, it's can be a very dangerous game to play. It could be your parents, it could be your sibling, it could be your own children. What you need to understand is that the second they don't pay or they can't pay, you will be responsible. There is no getting out of it. you will be responsible. And one way to think about it is if they need a cosigner to begin with, this person may not be suitable to get that loan. The fact that they need a cosigner actually indicates that there's a high chance they're not going to be able to pay. So you have to be very careful with this, and not recommended to do unless there's some really tough or extreme circumstances where you have to do it. But I'll always think of that. If they need a cosigner, there's a reason why they need a cosigner. And that reason is because more than likely they should not be getting this loan. They cannot afford it. And you will end up being responsible for it. So if you cosign, plan it as if you're taking the loan yourself. Let's go ahead and pause the video here, and we'll do a part 2 for the rest of the slides.